The crypto world is buzzing, and for good reason. Bitcoin has just shattered another critical resistance level, a milestone that many analysts believed was months, if not years, away. This isn't just another number on a chart, it's a signal that the market dynamics are shifting in a profound way. What happens next could change everything for crypto investors, potentially reshaping the entire landscape for both seasoned veterans and newcomers alike. The stakes have never been higher. Welcome back to Crypto Insights, your essential guide for navigating the complexities of the digital asset space. I'm your host, and today we're diving deep into 5 game-changing developments that could shape Bitcoin's future. We'll explore the surge in institutional interest, groundbreaking technological upgrades, shifting regulatory tides, and the macroeconomic factors that could either propel Bitcoin to new all-time highs or trigger a significant correction. We're cutting through the noise to bring you the analysis you truly need. But before we jump in, if you want to stay ahead, make sure to hit that subscribe button and ring the notification bell. As a special gift for our community, I'm giving away my exclusive Bitcoin analysis toolkit completely free. It includes my personal checklist for evaluating projects, key on-chain metric trackers, and a risk management calculator to help you make smarter decisions. The link is in the description below. Now let's get started. First up, let's talk about Bitcoin's current price action. As of today, Bitcoin is trading in a tight range that has captured the attention of both seasoned institutional players and the ever-watchful retail investor community. We've seen a period of consolidation after a significant run-up with the price testing key psychological levels. This delicate balance has everyone asking, what comes next? The recent volatility isn't random, it's being driven by a confluence of powerful forces. On the macroeconomic front, all eyes are on central banks. Inflation data and subsequent interest rate decisions from the Federal Reserve are creating major headwinds. Typically, higher interest rates strengthen the dollar and make risk-on assets like Bitcoin less attractive as investors can get safer yields elsewhere. We're seeing Bitcoin's price react almost instantly to CPI reports and Fed announcements, highlighting its increasing integration into the global macro landscape. What's particularly interesting is how Bitcoin has been responding to traditional market pressures, at times moving in lockstep with tech stocks, and at other times, showing signs of decoupling, attempting to live up to its digital gold narrative. From a technical analysis perspective, the chart is telling a fascinating story. We're currently hovering above a critical support level, which many analysts identify as the 50-week moving average, a long-term trend indicator. A sustained break below this could signal a deeper correction, with the next major support zone found near the previous cycle's all-time high. Conversely, a key resistance level looms overhead. To confirm a bullish breakout, we'd need to see a decisive move above this ceiling, supported by a significant increase in trading volume. Indicators like the Relative Strength Index, or RSI, are currently in neutral territory, suggesting the market is undecided. The next few weeks are pivotal. They could determine whether we gather the momentum for a breakout to new highs, or enter a more prolonged corrective phase. Second, let's examine what the experts are predicting for Bitcoin's future. The spectrum of forecasts is wider than ever, ranging from extreme bullishness to deep skepticism. On one end, you have some of the most respected analysts in the space who have shared incredibly optimistic forecasts. For instance, Cathie Wood from ARK Invest has famously reiterated her firm's bull case for Bitcoin reaching over $1 million per coin by 2030. Her thesis is built on the projection that institutions will begin making strategic allocations of just 1 to 5% of their portfolios into Bitcoin, unleashing a torrent of capital into a scarce asset. On the other hand, strategists from major banks like JP Morgan remain more cautious, citing regulatory headwinds and the potential for sustained high interest rates as significant risks that could temper Bitcoin's growth in the medium term. Despite these differing views, a consensus seems to be forming around the idea that Bitcoin's long-term fundamentals remain incredibly strong, regardless of short-term price fluctuations. What's particularly noteworthy is how these predictions align with on-chain metrics. On-chain data, which is information pulled directly from the public blockchain, gives us a transparent view of network health and investor behavior. Metrics like the long-term holder supply show that seasoned investors are continuing to accumulate coins and are not selling into the volatility, a sign of strong conviction. Furthermore, we're consistently seeing a net outflow of Bitcoin from exchanges to private wallets. This indicates that investors are moving their assets into cold storage for long-term holding, reducing the immediately sellable supply and reinforcing the bullish long-term case. Third, the evolving regulatory landscape continues to be a primary force shaping Bitcoin's trajectory. Recent announcements from major economies have provided both much-needed clarity and new challenges, acting as a double-edged sword for the industry. In Europe, the Markets in Crypto Assets Regulation, or MiCA, is now in effect. This comprehensive framework provides a single set of rules for the entire EU, creating a clear, harmonized market that is expected to foster innovation and attract institutional capital. Meanwhile, the United States is still navigating its path toward comprehensive crypto legislation. The ongoing debate between the SEC and the CFTC over whether Bitcoin and other crypto assets are securities or commodities remains a key point of contention. However, bipartisan efforts like the Financial Innovation and Technology for the 21st Century Act, or FIT21, show a growing recognition in Washington that clear rules are needed. These frameworks are crucial for creating the institutional confidence required for pension funds and other conservative allocators to enter the market. However, the global picture isn't uniformly positive. Some jurisdictions are taking a more restrictive approach. China's blanket ban on mining and trading, for example, initially sent shockwaves through the market. Yet, it also had the unintended positive consequence of decentralizing the mining industry across the globe, making the network more resilient than ever. These differing national strategies create a complex global patchwork that could impact adoption and trading volumes in the short term. Fourth, and perhaps most importantly for this market cycle, institutional adoption is accelerating at an unprecedented pace. The narrative has firmly shifted from if institutions will adopt Bitcoin to how quickly. Major corporations and financial institutions are now actively integrating Bitcoin into their strategies and products. The launch of spot Bitcoin ETFs in the United States has been an absolute game changer. Financial giants like BlackRock and Fidelity have unleashed products that allow anyone with a brokerage account to gain exposure to Bitcoin easily and securely. These ETFs have seen tens of billions of dollars in net inflows in a matter of months, creating a relentless wave of new demand. This institutional demand is creating a powerful supply squeeze. Remember, Bitcoin has a fixed supply of 21 million coins, and the issuance of new coins is cut in half every 4 years in an event called the halving. When you have a fire hose of demand from Wall Street meeting a garden hose of new supply, the basic laws of economics suggest that prices have a strong tailwind. This represents a fundamental change in how Bitcoin is perceived by traditional finance. It's no longer just a speculative bet for retail traders, it's now being treated as a legitimate strategic allocation for diversified portfolios, a potential hedge against inflation and currency debasement. Finally, let's look past the price and examine Bitcoin's network fundamentals, which remain incredibly strong and are arguably the most important indicator of its long-term health. The network's hash rate, the total computational power dedicated to securing the blockchain, has reached new all-time highs. This is a powerful metric. It means that despite price volatility, miners are investing more capital than ever into the network, signaling immense confidence in Bitcoin's long-term profitability and security. The network has never been more robust or resistant to attack. Beyond security, the network is also scaling. Layer 2 solutions like the Lightning Network are growing rapidly, enabling faster and cheaper transactions and preparing Bitcoin for global, everyday use. Additionally, the narrative around Bitcoin's energy consumption is becoming more nuanced. The shift toward renewable and stranded energy sources is accelerating, driven by the economic incentive for miners to find the cheapest power available. This is not only addressing environmental concerns but is also, in some cases, helping to fund and stabilize renewable energy grids, making Bitcoin a more sustainable and integrated part of our future energy infrastructure. So, as we wrap up, let's crystallize the key takeaways. We dissected the current price action, identifying critical support and resistance zones. We then explored the spectrum of expert predictions, noting a cautiously optimistic consensus for the medium term. From there, we navigated the evolving regulatory landscape, focusing on the potential impact of spot Bitcoin ETFs. We also highlighted the undeniable trend of accelerating institutional adoption and affirmed the robust health of the network itself, with the hash rate consistently hitting new all-time highs, proving its security and resilience. Putting these pieces together, the picture becomes clearer. While short-term volatility is a given, the long-term trajectory for Bitcoin appears fundamentally strong. We're approaching the next Bitcoin halving, a programmed supply shock that has historically preceded major bull runs. Furthermore, in a world of persistent inflation, Bitcoin's narrative as digital gold, a decentralized and scarce store of value, is resonating more powerfully than ever. This is a paradigm shift in how we perceive value. Now it's crucial to remember that none of this is financial advice. The crypto market carries inherent risks, which is why doing your own research is so vital. That means understanding your personal risk tolerance and developing a clear investment thesis. Our goal is to provide high-quality information so you can make more confident decisions for yourself. If you found this deep dive valuable, please consider subscribing and hitting that like button. It's a free way to support our work and helps us reach others looking for clear crypto content. I'd also love to hear from you. What are your predictions for Bitcoin this year? Drop your thoughts in the comments below. Let's start a conversation. And don't forget to grab your free Bitcoin analysis toolkit, available via the first link in the description. It's the collection of resources I use daily, including custom chart layouts and key on-chain indicators. It's designed to empower your own research, and it's my gift to you for being part of this community. Make sure you're subscribed because next week we're tackling the biggest debate in crypto, Ethereum versus Bitcoin. Will Ethereum's utility and ecosystem allow it to flip in Bitcoin's market cap? Or will Bitcoin's status as digital gold ensure its dominance? It's a fundamental comparison you won't want to miss. Thank you for your time and attention today. Stay curious, stay informed, and I'll see you in the next video.